What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello, welcome back to What's Making Headlines. It's your host Annie Kane here with team members Ben Squires and Will Paige, unpacking the things that we've been writing about this week on The Advisor and the things that we've been doing as well. And such a big week we've had this week, capping it all off today with the Australian Broking Awards, which was super exciting. Run a partnership with our principal partner, NAB. Will, I think this was your first ABAs. What do you think?
Yeah, it was great. Really good opportunity to kind of network and speak to people in the industry. Just a fun day as well. Nice to have Friday afternoon, a bit more chilled.
Yeah, I think a lot of people appreciate that it's a daytime event, so you can go and still continue your weekend as you normally would. It does feel weird, though, having an after party that starts at like 3 o'clock. But, you know, I quite like that. You can have an after party and then you get home for 5 p.m.
Exactly. Yeah, I'd say it's nice.
Not that I did.
Yes, yeah.
But yeah, how did you find it, Ben?
Yeah, it's great. This is my second one now. It's one of our really big events, but it was also a massive week of news as well. So there's been so much going on.
Huge week of news and actually a big week of events as well. I actually attended the Mortgage Choice National Conference this week, which was great. It was actually a 3-day summit that they did. And I think Loan Market earlier this year also did a multi-day summit. So really loads of content, loads of networking. I only went to attend one of the days. I didn't go to all three, but the one I did attend was when Anthony Waldron was revealing what the brokerage was doing in terms of AI, which of course has been a major point of conversation for many brokerages, both Loan Market earlier this year, as I've already mentioned, they unpacked their AI strategy. Aussie also announced what they were doing with AI. So we were desperate to hear what Mortgage Choice was up to. I knew it must have been coming because everyone's been playing around with the tools. So it was really great to hear from Anthony Waldron, the CEO of Mortgage Choice, about what exactly they're doing, but also from the people who are building the technology as well. There was a demonstration from Damon Roberts, who's REA Group's Director of Engineering for Financial Services, and Ali Gu, who's the AI Senior Product Manager and Data Manager. And they were sort of showcasing what they've been building for the Mortgage Choice brokers to help them get more efficient. And a lot of it is kind of Gemini based so far. So they use Google sort of suite, and Gemini built into a lot of it. So they had some interesting ones that I think we've kind of seen being rolled out across the board to really free up broker time from the admin. So one was a social media assistant. So basically you could use Gemini and be like, come up with a social media post on X, Y, and Z, and it does it for all the different channels. It comes up with the hashtags, it can generate images, but it does it in the style that obviously Mortgage Choice wants and kind of in their house style. They also have a meeting assistant. So when they have client meetings, it will kind of transcribe and then summarize what the meeting was about, and then sort of draft follow-up emails that the broker can use and immediately export to Gmail. And then they have a document assistant that will review all the client files and documents and be like, if there's any discrepancies. So let's say if your pay slip and your tax return don't show the same income, it will flag that. So it's kind of saves some of the brokers having to do that manual line-by-line checking. Or if there's something in the bank statement, for example, that hasn't been talked about previously, they can go back and do that. So some really interesting tools there. And I think that's sort of the low-hanging fruit of what brokers were wanting to see. So it's great to see that's been enabled. But some of the ones that were more exciting, I think brokers were interested in, was looking at the things that's coming up. So currently they're testing a lead management AI. So that will show, using all the data that Mortgage Choice has through its parent company, REA. So the realestate.com.au platform has got this amazing sort of data back engine where you can see your property price, you can have a look at how much equity you have. Anyway, based on what the consumers are doing on that platform, it will notify the Mortgage Choice broker, if they have one, to be like, oh, hey, we've actually seen this client has reached this particular maybe equity level, or they've been looking at loads of properties recently. So it's kind of flagging a propensity to do something. So maybe particularly refinance. So if they get to a certain point where they might be thinking about refinancing, it will notify the broker to be like, maybe we get in touch and see what your client needs. That was quite interesting. And then they also have a client relationship AI, a policy search AI that can kind of map lender requirements into an easy to read table. So again, pulling on multiple sources and tools and using Mortgage Choice's own data, it will kind of say, based on what you're talking about, here are some of the policy searches, some of the lenders that might be relevant for your client. They do also have some future ones that they're thinking about using. I don't think they've started testing these yet. So this includes one which is an AI assistant loan submission system to help preempt if there's any errors in the loan submission. And then another one is sort of looking at a live product search. So while they're actually doing the client meeting, they can kind of search through all the different lender policies and be like, based on what you've told me, this is the rate that I think you can get. This is the lender that I think you can go to. And before they do all the actual kind of proper dig through of what they need to do in sort of checks and balances. So I thought those were all quite interesting, and it was great to hear from the actual people building the tools to be like what you're doing and why we're doing it. And I think this brings me to a bigger point, which is around like, well, with all of this AI coming out, what exactly is a broker going to be doing? Because it sounds like they're kind of getting off with a lot of their workload being unloaded from them. Where do you guys see the role of a broker with all this AI evolution?
The line that sort of gets trotted out again and again is the idea that all these sort of innovations are going to free up the broker's time to do sort of more strategic client relationship things, which I suppose makes sense. But yeah, it'd be interesting to see what that looks like when you've suddenly got 60% more time in your day. I guess, does that mean everyone gets more clients? And
you'd think then it would make the broking industry much more strong, because they should be able to then find more clients, write more business. So potentially, if you're getting back, let's say 30% of your time in the day, in the week, then you could get 30% more clients, in theory. Well, no. But, you could use that time to actually get more clients. So I think you could see the ramification being the broker channel just booming in terms of operations. Will, do you agree with that? Or do you think it will be like, it will actually push brokers out?
I don't think it will push brokers out. I think it would be interesting in the short term. Hypothetically, if you were talking to a client and it gave you these options that AI did, and then you said, oh, this is what the system's saying, and then actually you checked it and it was wrong. As a client, you'd be like, oh, that's pretty annoying.
Yeah.
Just the teething of actually using the tech, I think would be quite interesting how brokers manage it.
I think that's probably why they haven't yet started testing it, because I imagine they're probably nervous about that too.
Yeah.
Being like, we don't want to say you can get a rate of, let's say, 5.4 and borrow this much money, and then you get all the information from the client and you go, actually, because of your liabilities that you forgot to tell me, we can't do that, and you've gotten all excited. Kind of be sad. So I think that is an interesting one.
I mean, it's positive. That stuff to do with meetings. That'd be so nice if AI could, transcribe it, come up with emails, come up with opportunities and stuff. You think that's where I don't want to say boring admin, but the time-consuming admin can cut down on. That's
100%.
A positive thing. Definitely.
And of course, they can still obviously edit anything that comes through. But I think, they actually did a live demo of that, and I was like, oh, I want that. That looks really, really good.
Yeah.
But obviously we have live transcription tools that can summarize stuff, and I just don't have a version that yet knows my voice and then can write an email based on what I'm doing. I'm like, I'll save some time.
Yeah. I think the point about the social media stuff was quite interesting as well, and because some people probably social media naturals, but other people probably think they should be doing it, but wouldn't know the best place to get started. Yeah. So to have something that sort of gives you a place to start and create something that is on brand and everything.
Yeah, exactly. And I think that's also, kind of the interesting thing, and probably something that I would be curious about was being like, well, does that mean that it comes up with the same social media post for everyone, or is it coming up with unique ones? Because obviously you don't want to see 1,000 of the same post. So
I did think that about, if you go on LinkedIn now, and there's a lot that are tonally very similar.
Yeah.
They can't all be writing the same. It's because more people use generative AI.
Yeah.
But if you just tweak it, I guess, and say, write it in the voice of my brand.
Yeah. And it's all obviously behind the in the workplace. So again, a lot of these tools, I think of the brokerages are kind of rolling out a lot of this AI tech because they're worried about brokers using their own tech but not doing it in a data safe way.
Yeah.
So particularly when it comes to things like if you've got any client information like client recordings, you don't want that in general, open, free to access platforms where you don't know where that data is being held, you don't know how secure it is, if it's got personal information in there and easily sort of identifiable. personal information and financial information is very important. So yeah, I think a lot of brokerages are kind of having to accelerate the rollout of all this AI tech because they're like, only use it within our system and the way we want you to use it from a compliance perspective, but also from a data security perspective. You know, if you do get hacked, then it's obviously the aggregator's problem, not the individual broker's problem. So I thought that was pretty interesting, the Mortgage Choice event, and all that kind of, all the things that go with it, you know, talking to brokers. It was really great as well, actually, having brokers come and say hello that listen to the podcast, and a lot of people kind of saying, you know, they've been learning a lot through it. So it's great to have that feedback. And if you do have anything else that you want us to be talking about on this podcast or our broker podcast, do let us know. But big news again this week. So let's go through some of the big headlines. We started the week with a bang because over the weekend, the government came out and announced a whole range of housing reforms. Plus on Monday morning, I think it was, Prime Minister Albanese brought forward the home guarantee expansion. Now, Will, you were across this story on Monday morning. What happened?
Yep. So as you said, brought forward first home guarantee scheme by 3 months. So it will begin on the 1st of October this year.
The expanded home guarantee.
Expanded, exactly. And it's essentially all eligible first-home buyers can get access to a 5% deposit guarantee with no income or place caps. And they've also increased some of the property price caps for capitals and regions. Not all of them, but most of them, I'd say.
Yeah,
it's worth
Sydney's
just checking.
a big one, yeah.
Yeah, and some of them are quite sizable, just to reflect the reality of the new kind of house prices. And I mean, the reaction broadly positive, I'd say, from the industry. FPAA MD Peter White described them as good news for borrowers and a good news for brokers who will be best placed to assist first-home buyers. He did caution that to improve affordability, the government also needs to work to increase supply. I'd probably say that's the major critique, was to do with they're obviously tinkering with the demand side. And to manage affordability, then you also need to increase supply. MFAA CEO Anya Panik, maybe not quite as upbeat, but she welcomed the broadening of lenders, which includes smaller customer-owned and regional banks. She said, it's crucial that the scheme operates with lenders who partner with mortgage brokers. This will ensure that first-home buyers get the expert advice and support they need. So yeah, generally positive. I think most people kind of viewed it as a positive for first-time buyers.
Yeah, because I think at the moment, in terms of the amount of loans that are written through the first home guarantee, it was something like 6,000, I think, a year. I'm actually just going to double check that. Hang on a second, because I just pulled up the commentary that came from Claire O'Neill, who's the housing minister, and what I think she referred to it. So Claire O'Neill put out a statement when she was talking about this, I think actually in Parliament when they were kind of bringing in the legislation. And she was saying that about 180,000 Australians have so far through the home guarantee scheme taken out a loan with the 5 deposit that they need. And then the government guarantees of the 15%. So that's quite a big number. But looking at this, they were talking about the fact that by removing the income cap, so it's no longer going to be means tested, and by increasing the price limits, they're going to have so many more people in market. Now, I think in terms of actually how many they're going to be having, they haven't really got like a proper number on it. But she did unpack some examples, and these are the ones that I thought were quite interesting. So she said in Brisbane, for example, the average house price is about $1 million, which means that to buy an average house with a 20% deposit, you'd need $200,000. She's saying for an average first-time buyer, it would take 13 years to save that much money, and you might not be able to buy it until you're much later. But and then also, this is, I thought, very interesting. She said, if they decided to buy without a 20% deposit, they'd be whacked with up to $43,000 in mortgage insurance, making a huge dent in her savings. Now, this is the conversation, I think, that has been going on our System Title Broker Daily, is being like, what on earth are they doing to LMI providers? You know, mortgage insurer providers like Helia, for example, a big provider, they're like, well, you've kind of now made our business almost defunct. If you're making all first home buyers available through this scheme, what does that mean for our business model? You do feel very sorry for them. I know that you spoke recently with Helia, Ben, for our magazine and podcast. And I think the conversation there was around, like, there's a lot of misconceptions around LMI and what it can do. And sure, $40,000 in mortgage insurance might be a lot, but the cost of the property would go up by more than that, surely. in like a year. So you're kind of like, well, actually, that's still a good deal.
Yeah, absolutely. And I mean, similar to, it's all about sort of getting into the property as soon as possible and sort of improving your equity position, I suppose. But yeah, it'll be interesting to see what these government changes mean for LMI providers.
So yeah, so I think they were, Claire O'Neill was saying, on average, there's going to be 6,000 more first home buyer loans a year under this program compared to the previous one that was, well, she's talking about the coalition, but like, whenever this was. So she was sort of saying, there's going to be a lot more, but I just don't know about this. I'm a bit like, I'm worried about the supply side pushing up prices. If you've got all these first home buyers coming into market, there has been some commentary from economists I've seen talking about trying to quantify what it would do to house prices. And some are saying it will likely push house prices up in the immediate first year, but it will kind of then even back out because it's saying it's actually just bringing forward people who are going to be in market anyway. So it's just going to mean the first year there'll be loads more of them, and then kind of the second and third years there'll be fewer. So it will temper out. So hopefully house price increases will just be in the first year, but I'm not sold on that.
Yeah. I guess the other thing, being ultra cynical, is the cost. We tried to roughly work out what it could cost the government because they didn't cost any of it.
They didn't. It's so annoying. You're right.
Yeah.
We went through the budget papers because when they released the budget earlier this year, it wasn't in there,
Yeah.
the expanded scheme. So we were like, well, how much is this going to cost? And yeah, billions and billions, obviously. And more to the point, what happens if you default on your loan? So like, who's actually paying for this? Is it the taxpayer? Like, well, I don't understand. I don't understand where the money's coming from.
Yeah, who carries the risk? I guess would be the government.
Because
really.
the government's
Yeah.
the guarantor. So you're like, well, if you're saying we'll guarantee you for 15% and then you start defaulting on your loan, like,
Yeah.
I just don't know what
It's
happens.
kind of, again, being cynical from like a politician's view. To help home buyers, the best thing would be to lift supply, which takes time.
Yeah.
They don't have time, so they need a quicker solution.
From a political point of view, very popular.
So they're obviously funding it,
Yeah.
but then there's other repercussions.
Yep. I'd like to see the money, please. How much is this all costing?
They will have to cost it, surely.
Yeah, they will. It
Yeah.
will be in the next budget. But
Yeah.
of course, like, I'm just like, how have we not seen these figures? How has nobody challenged
Yeah.
them yet to be like, sorry, how much is this costing? So I think that would be interesting for us to see. But that was some of the big news, and it was great to see different reactions from it on different sort of concerns and thought processes of what this will do for home buyers and for brokers more broadly. Of course, everyone's sort of agreeing that because brokers generally are helping so many first home buyers anyway, it will just mean more business for brokers, which is great. We've also been going through still the longest reporting season I think we've had for a while, still going through financial reports for some of the aggregators and lenders, and we'll get into that just after this. So end of financial year 2025 back in June, and we always know that in August we'll have all of the results coming out from the people who are in FY25 ending June. But this year felt like it started earlier and is still going on longer than normal. We've had a few this week that caught our eye. Ben, I think you wrote up the AFG results. What's happening over at the aggregation group?
Yeah, so AFG put out their results earlier this week. Record volumes, lodgement and settlement volumes, and record broker numbers. So, according to AFG, resi lodgements climbed 18% in FY25 to 101 billion, while settlements rose 15% to 63 billion. So AFG's total residential loan book hit 210 billion, which is a 5% year-on-year increase.
That's really interesting. I always think AFG's reporting is weird because lodgements were what, sorry? 100?
Lodgements climbed 18%
to what?
101 billion.
To 101 billion,
Yeah.
but then much less actually settled. So what was the settlement figure?
63 billion. So that was up
it's a
15%.
Big difference. I'm wondering what the difference is there, because I wouldn't have thought that it's taking longer to settle a loan. Perhaps it's that it's borrowers finding it harder to actually get a property, so they're not settling.
Yeah, perhaps.
I'm just
Be a
wondering
bit
what that
pre-approval,
differential is. We'll have to ask him. But yeah, that's a huge loan book now. And yeah, well, broker numbers, do we have an idea on how many they have now?
Yeah, that was another interesting thing to pull out of the report. So the broker network has also hit a record high in FY25. They have 4,200 active brokers now writing loans for AFG or Fintelligence, the asset finance aggregator it acquired last year.
Yeah.
Which is up 5% year on year. our readers will know, AFG has sort of been trying to invest in broker businesses as well. During the last reporting season, it sort of announced strategic partnerships with LoanPath Finance, Empower Wealth Group, and Lifespan Mortgage Services. And I think AFG expects to have 35 equity broker investments by FY29.
FY29, yeah. So they have this kind of like, what is that? 3-year strategy if we think we're in FY26 now. And I thought that was really interesting. Like 35 that's a lot of money to be investing in individual broker businesses. So I thought that was really interesting. I also thought the white label increases were also interesting. So as we know, AFG has a wholesale lending arm and their own white label mortgage brand, AFG Home Loans. And they had both seen quite strong increases too. Yeah,
AFG Home Loans rose 23% to 4.3 billion. The total loan book rebounded as well. I think it had a softer FY24 compared to the year before, but this year it was up 8% to 13.8 billion. And AFG Securities had its highest settlement volume since FY22. It was up 65% year on year to 2.7 billion, while the total loan book grew 23% to $5.4 billion, which is massive.
And I think this is part of AFG's strategy to increase margins by actually becoming like a distribution arm. So I think that side of the business is called distribution. No, it's called manufacturing.
Manufacturing.
And distribution is obviously the broker side. But yeah, looking at how they can be making money, it's always great having a listed business because we get to see all of this information in real detail. Another aggregation group that released their results this week included Finsure, which is part of MA Financial, and MA Financial was the parent company who released their results. What did the Finsure results tell us?
Yeah, so half-year results at Finsure, they posted record monthly settlements from Finsure brokers. So they closed the period a record 155 billion. That's up 28% on the previous year. And strong loan settlements kind of throughout the year, so it grew as the half-year period went on. Finsure brokers lodged a record 10 billion in July.
Yeah.
Obviously, second half now.
And I think AFG also mentioned that. So they were talking about the fact that the second half of the year and really the last quarter of the year was seeing really high volumes, partly because of the rate cut that started in February kind of being flowing through, but also because we're getting closer to the spring season.
Yeah, and there was a lot actually about that, about spring specifically. They said they expected it to keep accelerating.
Yeah, but future vision's easy to talk about. Being like, it'll be huge, and then you have no idea. But for FY25, and they're a similar size, aren't they, to AFG? They've got about 4,000 odd brokers. Did they tell you in the results how many brokers they have now?
I think they did. Off the top of my head, I actually don't have that figure. They've got 18% of the market now, they claimed.
According to MFAA, if they overlaid their figures, I think it was around 4,000 something.
Yeah, it's just over 4,000, I think.
And so similarly to AFG, and also interesting, similar that both of them have written over $100 billion this FY.
Yeah.
So huge volumes coming through the broker channel. And the other arm of MA Financial is also MA Money, and that had also seen lodgements go up. Can you give us some of the headlines from that?
Yeah, so it doubled its loan book, closed the period, loan book $3.3 billion, so really strong growth for the mortgage lending arm.
Yeah. Talking of lenders, I covered the Liberty results this week, the non-bank lending group, and this was really interesting to me, actually, the Liberty results, because they kind of weren't what I was expecting at all. So having a look at them, they wrote $5 billion in loans over FY25, down from 5.7, so 5.1 in FY25, and it was 5.7 in 2024. Now, I would have thought that figure would have gone up based on what's happening in market, the fact that we know it's been a super popular year. So I was kind of surprised by that. Its overall portfolio edged up slightly to 14.7 billion. It was 14.6 billion. So again, not a huge amount of growth. And really, I was kind of talking to the CEO about what was driving this, because I was like, it really surprised me. And he was saying it was actually really competitive pressures. So other non-banks pricing quite aggressively and higher customer refinancing as a result of higher of competitive pricing. So overall, Liberty's residential loan book actually fell 2% in FY25. So it dropped from 7.9 billion to 7.7 billion as discharges rose, and they rose to 38%. So they exceeded the new originations. New originations, talking of which, generally steady year on year at about 3 billion and skewed towards unlike others, skewed towards the first half of the year. So I was a bit like, this is really
Almost the opposite.
complete opposite story that we're hearing from everybody else. So I was a bit like, it's really unusual. And so, I did talk to James Boyle, who's the CEO at Liberty, and I was sort of saying what's happened here. And he did mention they've had disciplined approach to growth and they're not chasing lowest cost, looking at balancing the front book and retention. So he's saying, discharges have been heightened because of rampant competition, as he called it. And he did also flag that brokers are obviously doing a great job in helping customers who are feeling the impacts of higher interest rates finding cheaper ones. But he did say that applications were 33% higher in the final quarter of the year. So he also expects, like Finsure and AFG are saying, a stronger FY26 based on the fact that originations are increasing, lodgements are increasing. So looking at what they were kind of doing moving forward as well, he was also looking at quite a bit at the commercial arm. So Liberty's secured business, which includes commercial mortgages and motor finance, that actually expanded, unlike the resi book. So that expanded to 5.9 billion. Originations, though, also slipped. So fell from 2.1 last year to 1.6 this year. So that side of the new business coming down. And they, again, said reflecting cost discipline. So, and competitive market. So I think generally I was really surprised in this personal lending originations dropped as well. So all of this kind of feeding into perhaps what you might say is less than ideal circumstances for a lending book when you're in a pretty nice lending environment. However, they did have great net interest margin and improved profits this year. So from a shareholder perspective, really great news story. And I think from the CEO's perspective as well, he's like, this is part of what we've been doing is we've not been trying to cannibalize our own profits. We want to make sure that we're actually making money. So he was like, actually, it's a great results because we've got much more money coming through. And that means that we can therefore lend out more money. But yeah, we didn't have, unfortunately, the Liberty results don't break down what's happening at their aggregation arms. So we don't know what happens at LNS, Liberty Network Services, or NMB in terms of broker flows or lodgements. But the CFO, Peter Riedel, did tell me that they were higher in FY24 than in FY25 than they were in FY24. So saying good growth at the aggregators. We just don't know what that is. Other areas that we're seeing as well, of course, include the banks, and we'll get into what's happening at the banks just after this message. So the banking industry also included this week in some of the financial results that were released. Will, you wrote up the Bendigo ones, which we were quite interested in because the first ones that we've seen under the new Bendigo brand.
Yep, exactly. First one since they retired the Adelaide Bank brand. And pretty positive, really. Total loan book, that was up 6.3% to 85.9 billion. Home loan book up 7.6% to 66.6 billion. Kind of a couple of headlines. There was a lot in there actually about the new Bendigo lending platform, which we've covered before.
A lot. We've covered a lot.
Yes.
Yeah. We've
and they
done
were really big
podcasts
on that.
We've done sponsored content on that because they put so much money. It was like billions of dollars into this new lending platform, and they rolled it out first with broker as well. So yeah, we've been talking about it a lot.
And I think time as well. They said it 5 years ago they first came up with the idea. So they were big on that. They said that made a really big difference. They also flagged stronger demand for digital mortgages. So its digital brand up. They almost tripled home lending over the year to 1.7 billion. And the other thing, interesting, improved contributions from its proprietary channel. And they actually broke that down month by month, and it had increased over the year. So that they wrote a greater share of loans compared to the broker channel as well.
Yeah, I think this is interesting because up, as you mentioned there, the increase on home lending up to 1.7 billion, was it? Do you say?
Yeah, 1.7.
That's relatively small still.
Yeah.
But if that's increasing threefold or twofold, depending on which figures you're looking at, I mean, whether it's a book or the originations, like that's quite a lot. And that is a digital-only proprietary offering. No brokers can write an up loan. But then also if they're looking at branch and being like, we want to be getting a lot more home loan business through a proprietary network like many other banks are doing, that should also potentially be a worry. And I did note that in their results this year, they were talking about rolling out the lending platform now to branch network. So that will increase the turnaround times that the branch network is seeing, because currently it was just available through broker and I think mobile banking people, I think maybe. So yeah, really interesting to see this focus and being like, what exactly does that mean for everybody else? Now, I'd imagine Bendigo will say we want both. We want broker to be strong. We want proprietary to be strong, as everybody is saying. They don't want to have, one channel doing better than the other in spite of the other, if I will. But I think, just seeing a lot more focus on going into what they're offering. And actually, the bank, I think, said it was actually trying to make life easier for customers using digital. So again, I expect that brand will kind of increase the up round. I think we'll see more of that over the year. And business lending also increased over the year, as did agri, a little bit lower for both of them. But I think generally pretty positive feedback from Bendigo Bank on what they've been doing this financial year. And I think total loan book now 85.9 billion. So getting pretty large. But yeah, as you said, they're really interesting to see the full financial year results, because as you said, it's the first time we've seen it since they've moved over to the Bendigo brand. They've had this whole new lending platform in place. And I think about a third of it coming through retail. We're going to keep a close eye on that, because actually I think also in the second half, bank branches accounted for 38% of new business, which was up from 30% the previous half. So really seeing that turnaround quite quickly. So we're going to be closely monitoring that trend to see what else happens. But they weren't the only other bank we were talking about this week. We yesterday flashed a news story because Beyond Bank is looking at another merger. One of many in the mutual banking sector. They are looking to merge with Family First Credit Union. Excuse me. With Family First Credit Union trading as Family First Bank. And so this will bring together their, if approved, they will bring together their businesses and have about $11 billion in assets. So not a massive lender, but much bigger than they are as a combined entity, because they'd actually have 340,000 members. So what really this is going to do is help Beyond Bank kind of expand its presence, particularly here in New South Wales. So think the Family First Bank have a lot of branches and sort of a network up in the Blue Mountains, Lithgow, Bathurst area of New South Wales, as well as in Blackheath and Mudgee. So lovely mountainous areas, good wine regions as well. And so that will complement Beyond Bank's presence down in SA, ACT, Victoria, as well as other parts of New South Wales. So they've all said, we're doing our due diligence now. We're taking a look at it. We're going to have to go through all the regulatory processes of mergers. And both lenders saying, we'll retain all existing staff, maintain branch network if the merger proceeds. So looking forward, if all goes well, then it could be finalised later this year, in 2025. So talking about mutual banks, one of many. This has been like a general trend we've seen. I think, Ben, you and I were talking about it for the August edition of the magazine. So currently, this edition, our cover story was actually called Momentum of the Mutuals. And it was about all of these mergers that's been going on, because we've seen so many. What do you think sort of driving the mutual merger popularity contest?
I don't know. I think maybe all these lenders are sort of seeing the requirements in terms of technology and investment and that kind of thing, and sort of seeing some real benefits to getting a little bit more scale, the costs involved in that kind of thing. Yeah. So that could be one element why.
Yeah, and I think also probably looking at really having just a bigger presence, because as we can keep seeing from these financial results, for most of them, the banks are getting bigger and bigger. So they're kind of saying, well, we need more clients, we need more customers, and we want to, if they're a customer-owned bank particularly, ensure that we're still focused as a customer-owned bank and maybe merging with some other credit unions that are like-minded. Not the first one, though, that Beyond Bank has pursued in the last year, because they had actually looked at combining with Police and Nurses Limited, P&N. If you remember last year, they were going to look at merging with them, and that would have created an entity of about $20 billion of assets, so a bit bigger. But that collapsed in September, and we still don't know why. We just know that something came up in the due diligence process that P&N wasn't loving, And so they called off the merger. And the undisclosed issues that were raised obviously were big enough that they kind of ceased it. So I wonder if this will happen again now with Family First, if something else comes up that they don't like.
Yeah, I think, that's why they've got all those sort of
checks and balances
they have to jump through. But.
Yeah. So I think generally we'll continue looking at how this progresses and what happens. And if it is in 2025, then we only got a few more months left. So fingers crossed that all moves through quickly. Looking to next week then, we've got another big week coming up. Lots of things coming out, still financial reports coming out. We'll be still unpacking some of the announcements from Mortgage Choice from the conference, that the 3-day conference that they held. There's going to be lots of things on the horizon. But before then, any nice plans for the weekend?
Hopefully a bit of surfing if the weather holds up. Slightly lean one financially, so not too expensive. But looking forward to a chilled weekend.
Yeah. How about you, Ben?
I'm not too sure yet. I think probably just decompressing.
Yeah.
Been a big week.
I'm going to be detoxing a little bit, my poor liver. But I hope you all have a fab week. And if you've got anything you'd like us to know about or anything that you're announcing, do reach out. You can reach us at editor@theadvisor.com.au. You can reach out to me, Annie Kane, Ben Squires, or Will Paige on our LinkedIn or Instagram and our LinkedIn profiles. And of course, check out all of the other podcasts here on the Advisor Podcast Network. We'll catch you next time. Thanks for tuning in.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.